Welcome everyone to episode 3 of Byte-Sized Ethereum, where we make learning about Ethereum, blockchain technology, and other crypto assets accessible for everyone. Topher, I'm so excited for today's episode.
I am too. We're going to be talking about the term cryptocurrency.
Yeah, so let's get right into it and let everyone know what's going to be on the agenda for today, starting with the fact that cryptocurrency is actually, spoiler alert, a little bit of a misnomer in most use cases.
Yeah, I mean, really, it's more like a variety of crypto assets that are just as varied as the assets in the real world. And eventually, just like how e-commerce became commerce, it'll probably be that crypto assets just become assets. So maybe cryptocurrency as a phrase will only be around a little while longer.
Absolutely. And after that, we're going to be spending about half of the episode talking about current events. And it has really been a crazy week or so because a ton of regulators have been cracking down on centralized exchanges.
Yeah, I mean, as the laws are currently written, they don't really fall well. Crypto assets don't really fall well within them. So either laws will have to be rethought, or crypto companies and innovators are going to have to move around. I mean, some people say that if the government is too heavy-handed with this, a lot of the innovators are going to leave the US and try to pursue this elsewhere. So yeah, we're going to see how it's going to play out.
Well, I cannot wait to see your thoughts on these current events. Let's get right into it. But before we do, quick disclaimer, this should not be taken as financial advice, and we both do own Ether.
That's right. Let's get started.
The term cryptocurrency is actually a misnomer in most use cases. Most cryptocurrencies aren't actually trying to become currencies. A big misconception that many people have is that one day we're going to be using a leading cryptocurrency to buy everyday things like coffee. Isn't that right?
Yeah, generally a currency is something that you're going to use for everyday transactions. And so it needs to have at least three properties. One of those being that it is the unit of account. So it's the thing that the prices are actually denominated in when you're in a store or whatever. And then second, it needs to be the thing that you're actually using to hand to one another. And third, it needs to be retaining a good amount of value across multiple visits.
I love it. It's like you gave the textbook definition of currency. And currently, most of the world's leading currencies are fiat money, which would be a good time to get into what that means.
Yeah, when you use the word fiat currency, you're probably referring to government currencies, because the word fiat means valuable just by arbitrary order or decree. Someone just declared it valuable or whatever.
Right. And the way that currencies started having values initially was when they used to be on the gold standard.
Yeah, that's right. So after World War II, there was this thing called the Bretton Woods Agreement, and the Western nations came together and said, we're going to have our currencies be backed by a certain amount of gold. And so because of that, any unit of currency is actually like an IOU for a certain amount of gold. It just so happened that the United States had 2/3 of the world's gold at that time, but we can just ignore that for a second.
Right. We were in a really good position then. But what happened after the gold standard was ended in 1971 by Nixon?
Yeah, so France decided in 1971, hey, we want to redeem a bunch of these US dollars for gold. And Nixon was like, you know what? Never mind. US dollars are no longer backed by gold. And so by doing that, they were just declaring, we're going to continue to have these dollars freely float, and they're going to be valuable in and of themselves, but we're also going to keep the gold, and they're just two separate things now.
So basically, currency comes from our trust in government, and it has value because the government says so.
Yeah, so like it was kind of like a bootstrapping phase where initially it was an IOU, but then when you pull the rug out from beneath it, it somehow was continuing to function because it had been functioning for so long. And it's also the case that then enabled the government to do more inflation. So it used to be the government could only print enough money that they could then back with a certain amount of gold, but now they're able to print kind of at whim. And so they target 2% inflation a year, but because of COVID in 2020, it's actually currently 5%, which is kind of worrisome.
Right. And this is a big selling point I see in the Bitcoin community, talking about it as a hedge against inflation, since the US dollar is declining in terms of purchasing power over the time. But Bitcoin is supposed to be seen as something resistant to inflation because of the fixed supply. On this note, we can actually go back to how the term cryptocurrency originated, which was in the Bitcoin white paper, and then we can talk about how the idea of cryptocurrency changed over time.
Yeah, yeah. So in the original Bitcoin white paper, which is kind of like the declaration of the intent of what Bitcoin will be, kind of like your thesis statement, the creator of Bitcoin had called Bitcoin peer-to-peer digital cash. So it did kind of have the initial intention of being something like that. And you have to remember that Bitcoin stemmed out of decades of people working toward making a native digital currency for the internet. This was the cypherpunk mailing list where people were trying to have a digital currency. So that's why it was originally called cryptocurrency, because it really was just Bitcoin in the game at that time.
Right, but as Bitcoin moved from a theoretical idea to an actual application, there were a lot of technical challenges. When was it that the early community realized it wouldn't be viable as a medium of exchange?
Yeah, I mean, like one of the first bars to accept it was this German bar called Room 77. And it was kind of difficult to use it as a currency because Bitcoin has 10-minute block time. So it's 10 minutes between each time anything is published on the blockchain. And you kind of have to wait through a few of those to really be sure your transaction went through. So Room 77 would have to wait like an hour for the Bitcoin transaction to truly be confirmed. So that wasn't really viable. Another thing that was leading to it not being viable is as more and more people started using the blockchain, you would then have to pay more just to have your transaction included. So it might actually cost more to include your transaction than the actual amount you're sending to someone, which was a little ridiculous.
Yeah, so this was where the community shifted from thinking of Bitcoin as a viable medium of exchange to thinking about it more as digital gold, something that would be able to store value, even if not necessarily being able to do day to day transactions. And to go back to our point of Bitcoin supposedly being able to resist inflation, again, this is tied into the fixed supply of 21 million Bitcoins and decentralization. There's no central authority that can just go and print more Bitcoin. Maybe you could break this concept down a little bit further and compare it to how the current US fiat currency works.
Yeah, so the idea is pushing back against the arbitrary inflation that the government is allowed to do. And so you don't really want to put all of your wealth into dollars if the government's going to suddenly print a bunch of dollars and the dollars you're holding are now a smaller portion of the pie. And so Bitcoin's value proposition is that there's a fixed number of pieces of the pie. There's 21 million Bitcoins. And so because of that, if you have one Bitcoin, you will always have 1/21 millionth of the overall pie, and there's no additional inflation that will occur. And so the idea is you can then kind of trust in that. It's kind of like standing on solid ground, whereas fiat currency or government currency might be standing on shakier ground.
And this is what gave birth to the sound money meme that I see on Twitter all the time. I see all of these Bitcoin personalities talking about how Bitcoin is sound money. And then actually, I saw recently Ethereum people saying, well, actually, Ethereum is then ultrasound money. Can you explain what's going on here?
Yeah. So, like I said, Bitcoin's saying that standing on it is kind of standing on something firm. That's why they say it's sound money, because it has a true store of value, because this quantity isn't going to increase or whatever. And they've critiqued Ethereum by saying that the Ethereum community doesn't have this fixed number. And so, because of that, who knows? The developers of Ethereum could print as many as they want or whatever. But that's not at all how Ethereum actually works. Ether actually functions in a model where you burn a certain amount of currency whenever you do a transaction on the blockchain. And so because of that, there are so many transactions being done that actually the burning outweighs any new issuance that's occurring. And so Ether is actually deflationary. So as opposed to having a fixed cap, it actually has a decreasing number of units in existence.
This reminds me of this tweet I saw from a very influential Bitcoin figure this week, and it went something along the lines of Ethereum has an unlimited supply, just like the US dollar. The market cap is continuing to grow, but the dollar is losing purchasing power, so therefore Ether is no different than a fiat currency. What would you say to something like that?
Yeah, I mean, just because something has a fixed cap doesn't inherently make it valuable. Like, as we'll get into probably later in this episode, if not future ones, it's very easy to just spin up your own cryptocurrency. So I can spin up one that has 20 million units. I could spin up one that has 21,000 units, one that has 1 unit. And that doesn't make it 1,000 or 1,000,000 times more valuable than Bitcoin. Having a fixed supply is kind of beside the point. You have to also have that be doing something valuable. And Ether and Ethereum is providing the native currency for the future internet, for all of the different interactions that we have with one another. As we put those onto the blockchain, Ether is then required to conduct that. And so it is inherently valuable above and beyond any quibbling about how many exist or anything like that. And then as a second response to that tweet, that tweet also assumes that the developers of Ethereum, there's a small number of them, and they have the ability to print a huge amount at will, and no one's going to be upset about that, or no one can stop that or whatever, which isn't at all how Ethereum functions.
On the topic of how Ethereum is being discussed on social media, another thing that I often see when Bitcoiners say Ethereum is useless and not valuable is the term of ETH is money. What does that mean?
Yeah, so that's people who support Ethereum responding to Bitcoiners, and they're not implying that Ether is a currency. What they're implying is that Ether is inherently valuable. So there was this argument years ago that Ether is more just like the gasoline that you put in your car. It's just something that you need to briefly buy when you're going to then put something on the blockchain, put a transaction on the blockchain, and then you get rid of any excess that you have, because it's not like you store barrels of gasoline in your house for value. You instead store gold under your bed. And so Bitcoin is like gold and Ether is just like gasoline. And Ethereum people responded and said, no, actually, Ether has multiple reasons why it's independently valuable. So multiple ones that I just described. And so because of that, they have this mantra, ETH is money. But they're not meaning ETH is currency. They're just meaning ETH is independently valuable.
Got it. That makes a lot of sense. So if Ether is not a currency, but it does have value, and the reason why it has value, you were touching upon a little bit earlier, and it was related to how it's a native currency that is needed for extending the chain. Can you go a little bit further into how that works?
Yeah, so there's this big distinction between cryptocurrencies, between the native currency for a particular blockchain and then just other tokens slash assets that are built on top of a blockchain. And about 99% of the things that you see that are quote cryptocurrency, 99% of those are built on top of a blockchain, and only a tiny fraction are the native currency of the blockchain itself. And so the question would be, why do you need a native currency to the blockchain itself? And the answer is, when you're building a blockchain and you're wanting it to be self-sufficient, you need some way of paying people to extend that blockchain at the very tip of the blockchain. Remember how we're having people who are constructing the most recent events on this giant shared timeline. But you can't just like send someone dollars over PayPal or something, because then the whole blockchain is dependent on PayPal or dependent on dollars, or it's assuming the very structure that it's trying to replace. You're trying to come up with a self-sufficient digital money. And so to have a self-sufficient digital money, you need to have a native way to transfer value to people. But all you're really using that native currency for, in a currency sense, is just to pay people to extend the blockchain. It has other uses besides that, but not for paying for coffee or anything.
Got it. So in that case, the value of Ether is basically tied into the Ethereum blockchain and how it's going to be developing over time.
Yeah, that's exactly right. And because 99% of other cryptocurrencies are just tokens built on top of Ethereum, that then makes Ether super valuable, because for you to interact with any of those other ones, you have to interact with the Ethereum blockchain itself, which costs you Ether to do.
Okay, so there are a ton of tokens that are being spun up on top of the Ethereum blockchain. How easy is it to launch your own token?
It's incredibly easy. This is kind of like starting your own website or like creating a new spreadsheet on your computer or something. It's copy and paste. It's that easy. And that's why I'm worried that how easy it is to create tokens is then giving all cryptocurrency a bad name. Okay, because it's incredibly easy for an everyday person in their basement to create a new cryptocurrency. because remember, Ethereum's kind of like an iPhone. So it's kind of like someone spinning up a new app or spinning up a new website. They're just spinning up this random thing, giving it some title and some specific number of units. Let's say that there's 1 billion of whatever random new token you've created. And then they're posting it on places where it then appears side by side with all of these fundamentally important cryptocurrencies that are changing the world in interesting ways, and people are building interesting things on top of. And so it's a mistake for people to equate those two.
Right, and the most likely people to fall for this are also the people who are newer in the space, and that's really hard when part of what you want to get widespread adoption of a technology is for it to go into the general public. So I guess as people who are actually well read on the subject, it's kind of your responsibility to help in that situation. But how does the Ethereum community even try to do something like that?
Yeah, exactly. I mean, this was the big problem that was occurring in 2017 and 2018, and it led to a lot of the initial attention of regulators looking at cryptocurrency in general. Because originally, there was just kind of native tokens, and then people were realizing it's kind of hard to build stuff on Bitcoin, so we had to build Ethereum. And then people are like, okay, I could build stuff on Ethereum, but now one of the things I can build is upon making this project, I would like to crowdfund some money for this project. So some of the original actual projects who had functioning, working, good use cases were crowdfunding, and then other people and on the Ethereum blockchain and kind of like a Kickstarter type thing. And then other people came along and they're like, wait, I can just start a project and kickstart, and they were able to make money. And then someone else came along and was like, wait, I can just write the white paper of what I will potentially start, and people will give me money. And then it got to the point where people were like, I can just create a website that appears like I have a company behind me, but I'm just grabbing random screenshots from LinkedIn. And then people got to the point where they were like, I'm creating a fake website and I'm making up completely fake faces by like using deep fakes or whatever. And so then it got increasingly convincing retail people, everyday people, that these is just as valuable, when really it was getting increasingly shady.
Right. Well, anywhere where there's an opportunity for people to make money really quickly, that is going to attract a lot of scammers. But of course, that shouldn't detract away from the fact that this is actually, some very cool innovations that are happening right now. And also a big reason why we decided to start this together, to try to clear up some of those misconceptions from people who would otherwise not be able to have that information.
Exactly. It would really be a shame if people decided, well, because it's so easy to spin one up, that must mean they're all valueless, when that's not at all the case.
Absolutely. So, in summary, cryptocurrencies aren't just currencies most of the time. So, instead, maybe they should be referred to as crypto assets.
Yeah, that's exactly right. Because another problem that we have here is that a lot of people assume all cryptocurrencies are very similar to one another. They're all trying to serve the same function, when that's not at all the case. Some of them are trying to serve very different use cases. There are actually crypto assets that are trying to be more like currencies. There are other ones that are trying to not be like that at all. So I think it would be great for us to describe some of the different options, because people equating them all being identical is a really big headache.
Yeah, absolutely. And a helpful approach would be to compare these crypto assets to their counterpart in traditional finance, or at least the way that different governing bodies are trying to regulate them.
Yeah, yeah. So one of the big categories is what's called a security. Okay, so a security is kind of like a stock. Okay, a security is when you are investing in something, and you're depending on the efforts of others for this investment to make you money. And the government decided back in 1933, after the Great Depression, that there was kind of this big run up in prices in the 20s, and everyone was making money. And then suddenly there was this crash, and people realized that a bunch of more scammy people were making false promises. So the government stepped in, and in 1933 created the Securities Act and said, if you are going to be asking for our citizens to invest in your little thing, and you're promising them that you're going to give returns, you need to go through the government. You need to have the government's permission. You need to kind of have the government oversee this to make sure there's no shady business happening.
Right. So this was really initially intended to help protect US citizens. But it seems like now that there's such a new industry, the government doesn't exactly know how to regulate these different crypto assets.
Yeah, until cryptocurrency and blockchain technology came along, it was really hard to kind of create a brand new security like thing out of the blue. And so it was much easier to kind of tamp down any attempts for anyone to create an investment offering, and where they were offering that to everyday people or whatever. But now, with the ability for us to natively transact value online, that's an incredibly easy thing for two independent citizens to enter into. And so that's much harder for the government to follow up on and to try to keep all of that only in regulated venues, because there are so many people now able to transact freely with one another. So the government has to decide whether they're going to change their laws or whether they're going to kind of clamp down on everything.
Got it. So, what's an example of a crypto asset that the government regulates like a security?
Yeah, so the government declared that there's this token called the DAO. This was from back in 2016, and the government has declared that that was a security. So basically, the DAO was this attempt to make kind of a decentralized venture capital firm where anyone could put in money, and then that the DAO itself, this like group, would then invest that money in kind of startup type things, and then if that increased in value, you would then get a proportional amount of money back out of it. And the government has decreed that that, in their view, was a security. And because it was a security, that would then mean it's illegal for everyday people to have bought that, not on a regulated government venue, and without that having gone to the government and registering with them first.
Oh, wait. So then does that mean it ended up being shut down?
No, that we'll have to do an entire episode on the DAO as a whole, because that is a whole story in and of itself. But needless to say, it does not exist anymore.
Okay, fair enough. Well, in that case, then we can move to the next type of traditional asset class. So, commodities, any kind of tangible goods that can be bought, sold, or exchanged. And I know that Ether and Bitcoin are treated like commodities.
Yeah. So in particular, commodities aren't kind of all tangible assets that are bought, sold, and exchanged. It's more like examples in the real world might be something like corn or wheat or oil or something like that. So a commodity is more something that is used for some sort of useful function and potentially is grown or found or something like that. And although it's some of the high up people in the government have declared that Ether and Bitcoin both are seen as commodities and not securities. And that's a really big positive for the industry, because commodities are not as heavily regulated as securities in the US. And so Ether and Bitcoin, it's not illegal for you to buy or sell those without asking the government's permission first, because those are commodities.
Well, that is definitely a really big win. Do you think that's something that would ever change?
Well, so it's technically not been like instantiated into law that Ether and Bitcoin are commodities. It's just been stated multiple times by some of the high up officials at the SEC, which is the Securities and Exchange Commission, which is the US body in charge of securities. And for them to make a carve out and have said in their public statements, we don't view Ether and Bitcoin as a security, that has given a lot of people the green light to list Ether and Bitcoin. This is actually the reason, probably, I can't say for sure because I'm not involved with Robinhood, but this is probably the reason why Robinhood only lists Ether, Bitcoin, and things that are very Ether and Bitcoin like. So they have Ether, Bitcoin, all of the Ether and Bitcoin kind of copycats, and then they have Dogecoin, which is really just a fork of the Bitcoin type software. And so because of this, they're very in the legal green in the positive view of regulators, because those are all very commodity-esque cryptocurrencies. So they're not really dabbling in anything that might be viewed as more like a security.
Got it. Okay, that makes sense. So then a third example could be property. So anything that is owned. And this is similar to what we've seen in the crypto space with NFTs.
Yeah. So an NFT is a good example of property. Now, we haven't talked about NFTs yet on this podcast, so we'll do an entire episode on them. Maybe the brief description is an NFT is any unique good. Okay, so something like a dollar is not unique because I can hand you a dollar, you hand me a different dollar, and we don't care. Those are interchangeable. But an NFT is something that's not interchangeable. So it's like this particular baseball card or something like that is unique. And so because of that, NFTs are very much like property. The reason also why we should talk about property here is that the IRS is actually treating all crypto assets as property. And so that's been very complicated for taxes, because if you're then having to deal with your taxes, instead of them dealing with these things as securities or commodities or currencies or whatever else, they're all treating them all as property, which is confusing.
Wait, this sounds really confusing. How can it be the case that different government agencies are looking at these same crypto assets but defining them differently?
Yeah, well, each of those government agencies is kind of viewing a lot of cryptocurrency as similar, and then they're seeing certain ones that seem to fall under their purview. And since they're assuming all of the other ones are similar, then most things must fall under their purview. So, for example, the SEC is in charge of securities. They see a few things that look like securities, so they think all cryptocurrencies are securities. Commodities fall under the purview of the CFTC, the Commodities Futures Trading Commission, and they then maybe think a lot of things are commodities. The IRS treats crypto assets as property, and the IRS is in charge of taxes in the US. And then the Treasury Department slash FinCEN, which is kind of a subset of the Treasury Department, sees that there are kind of currency-like things in the cryptocurrency sphere. And so then they think a lot of crypto assets are like currencies.
Well, speaking of currencies, and I guess the big topic of our episode today, the closest thing to an actual currency or an actual digital currency is what we know as stablecoins. How would you describe a stablecoin?
Yeah, the simple description of a stablecoin is it's like a dollar on the blockchain. Okay, it's like a cryptocurrency that's intended to either track the price of a US dollar or track the price of another currency like a franc or a euro or something. Or even if it's not intended to track the price of a currency, it's intended to stay similar in value over time so that you could use it to buy and sell goods. So, for example, it could try to track the consumer price index, which is like how much bread you can buy with this currency, or this basket of basic goods that everyone would want to buy. So if you track that, then a stable coin would seemingly be the sort of medium of exchange that you would want to be using to buy your everyday coffee.
Right. And the reason why we want to have stable coins is because they would help provide, as you said, not just stability, but also liquidity on all kinds of digital exchanges. That being said, it's a really complicated subject. I mean, what do you even peg a stable coin to? Do you peg it to the dollar? Do you peg it to a crypto asset or a cryptocurrency? But I guess we'll be able to save that conversation for a future episode, since we could do an entire one just on stable coins.
Exactly. And I think one of our next ones should be on stable coins, because there's a lot of proposed regulation that's currently going through the government that is targeting stablecoins, and they have a very narrow understanding of what stablecoins could potentially be.
On that note, are there any last crypto asset classes that we may have missed?
Yeah, one other traditional asset class that a lot of people are lumping crypto assets into is what's called an intangible asset. And accountants are currently treating crypto assets as this. And an intangible asset is traditionally supposed to be something more just like intellectual property or like the reputation of your company. But for some reason, accountants are currently treating that crypto assets as that, and that's going to be a headache.
All right, so I guess we covered the different crypto assets then, and cryptocurrencies should actually be referred to as crypto assets. That's been my big takeaway from today.
Yeah, it should really be more of an umbrella term, and people should stop treating them as all being one type of thing, because just like how e-commerce eventually just became commerce, I think crypto assets will eventually just become assets. And really, everything that's being put on Ethereum and the blockchain right now is all of the different varieties of assets you already see in the everyday world right now. So stop treating them all as an identical thing.
On top of crypto assets, there's also big crypto companies, which perfectly leads us into the next segment of the podcast, which is talking about current events. And we've had just a wave of crazy events over the last week or so, with regulators cracking down on centralized exchanges, basically implying that they're going to go after anyone who touches US securities or US dollars outside of a regulated venue.
Yeah, I mean, in particular, some of these centralized exchanges were playing kind of fast and loose with the rules. They had more of a move fast and break things mentality, where they were just wanting to kind of grow at all costs, even when they were kind of ignoring some pretty obvious regulatory stuff. So I think some of the initial news isn't too surprising, but then the extent to which US regulators are going after them got increasingly surprising.
Well, I can't wait to hear your take on some of the specific events. So Maybe let's start with what happened with Binance, the largest cryptocurrency exchange, and they halted trading of all stock tokens, and they're currently being investigated by SECs around the world.
Yeah, so basically, it's not okay, according to SECs, for you to trade stocks at unregulated venues. Like the stocks that they were trading are literally US securities. Like they had tokens that were representing a share in Tesla or an Apple or something. And they claimed that they had an actual stock backing that token. And you were just kind of trading an IOU for that stock. And because it was the IOU and not the stock itself, they were then thinking maybe they're more in the clear. When very clearly, to a lot of legal analysts, they were not in the clear at all. This was not okay.
Right. It seems like they weren't just in a gray area. They were in a very, very dark area there where they knew they were going to get in trouble, but they seem to have this approach of move fast and break things. Why do they think they can get away with this?
Yeah, they were thinking more like, let's grow at all costs and instead kind of like ignore the current regulations and kind of break our way through. In particular, Binance moves its headquarters all the time. They kept headquartering in kind of shady countries that are a little more lax on regulation, and then the moment people would move in on them, they would then move their headquarters. So they've been seen by analysts as being less regulatorily compliant, whereas an exchange or an app more like Coinbase or Gemini are much more in line with US regulators.
Right. But Binance is still the largest cryptocurrency exchange. Do you think the fact that they were ignoring regulators is what helped them grow so quickly to begin with?
Yeah, but it's going to ultimately now come back to be their demise. So the UK has already now blocked all deposits of all citizens from putting any money onto the exchange, and the SECs in multiple different countries are now going after Binance. And so you can't ultimately claim that you're not domiciled in any country here, and you can't just indiscriminately violate everyone's laws and then think there won't be any consequences.
And are any of these new regulations also going to affect the exchanges that were playing by the rules, like Coinbase and Gemini?
I hope not, but I think the general sentiment toward cryptocurrency and in particular centralized exchanges will probably hurt Coinbase and Gemini and so on, because these more lax companies like both Binance, and there's one that was just shut down, or at least the founders were arrested, was called BitMEX. That was very much violating the laws. And then this new one, FTX, is also quite move fast and break things with their approach. I think all of those are giving kind of a bad name to the extent that these companies can play nice with regulators. Because in general, companies like Coinbase and Gemini are trying to be kind of a bridge between the traditional financial world and this new internet economy. And so for that bridge to function correctly, everyone in the Ethereum community is really supportive of them, playing nice to the extent that we can cooperate across the aisle.
Got it. And you brought up FTX, and they're still offering synthetic stock tokens. Do you think that they're going to also be investigated?
Probably they claim that because they're not offering them to US citizens, that makes them a little more okay, and because they're synthetic stocks instead of actually being stocks themselves. So Binance had been claiming they actually had a stock backing each of these stock tokens, whereas FTX instead has what's called a synthetic stock. So you can think of a synthetic stock as being, if you went over to your neighbor and you said to your neighbor, hey, I think Tesla's going to go up tomorrow, and your neighbor says, I think it's going to go down, let's bet each other and let's pay each other the difference of however much it goes up or down. Neither of you is actually putting any money into the company itself. Neither of you is gaining any ownership of the company itself or any voting rights or anything that a traditional stock would bring you. You're instead merely betting on the price going up and down. And so FTX was maybe thinking that that was more okay, when really legal analysts and so on say that even synthetic stocks are just as much violating securities regulations.
I also think that it's a really bad look for FTX to be doing something that is so legally shady while at the same time trying to prop up their brand image by, buying rights to Miami Heat, TSM, the esports team, and even Tom Brady's likability. What's going on there?
Yeah. So FTX bought the naming rights to the Miami Heat stadium. So that is now, the stadium is now named after them. They bought the naming rights to this esports team, TSM. so that now their jerseys have FTX shown on them or whatever. And even Tom Brady is now a spokesperson for FTX, and he posted a video of himself throwing a football to the moon, and the
Oh
football
my
was,
gosh.
yeah, the football was
I'm
overlaid with a
cringing. You
picture of
can't see
Bitcoin.
it, but I am.
Yeah. So that in general, I think, is giving a bad look to all of these exchanges that are trying to play nice with the regulators, and then we have these other exchanges that regulators are looking at and then thinking all exchanges are that out there.
Yeah, this I first saw it when TSM changed their name, since obviously, I'm a streamer, so I pay a lot of attention to the esports world, and I found it wild. Like, they must have been offered so much money to be willing to just completely change their branding like this.
Yeah, well, one reason why FTX and Binance had so much money is that both Binance and FTX actually created their own independent blockchain that compromised on the principles that Ethereum stands for. So one of the main principles Ethereum stands for is the ability to be decentralized. Okay, we're trying to create a new financial system that isn't dependent on any centralized parties. And to do that, Ethereum ends up being slower than it would be if you just had it all on one big super fast server. But both Binance and FTX said, you know what? Let's just make our own version of Ethereum that is super fast because it's on our own centralized server. And then they were kind of touting this as being better than Ethereum because it was so fast, when actually the reason it was fast was because it's centralized. And so that really left a bad taste in the mouth of a lot of the Ethereum community.
So that seems like the kind of situation where they're really just prioritizing the short term. Do you think this is going to hurt their likelihood of being around for a long time?
I mean, I would think so, but there's been other times when startups have broken the rules and then governments have given way or whatever. So it's kind of a scary position, because it would be worrisome to me if you're able to kind of get away with just breaking these rules. What we really need is we need people to rethink these laws and say, do these make sense anymore? But that doesn't mean that we should just break them in the first place. That potentially means that we should engage with regulators and our legislators and say, hey, let's maybe rewrite our laws and not just ignore them entirely.
Another similar headline was that Gary Gensler, the chairman of the SEC, is also going after synthetic stock, but he was also going after stablecoins that are backed by securities.
Yeah, this surprised people because generally the SEC, the Securities and Exchange Commission, should really only have their purview over securities. And Gary Gensler's argument was that if a stablecoin, remember, a stablecoin is kind of like a dollar on the blockchain. If it's backed by security-like things, then Gary Gensler says the SEC has purview over that.
Got it. And this was specific to the case of Tether that is owned by Bitfinex, because Tether is a stablecoin that actually had a big scandal some while back, because they were initially said to be pegged to the US dollar, but upon further investigation, they were actually pegged with securities.
Yeah, well, so the story behind Tether is long and circuitous, but the short version is that people initially thought Tether, for every single Tether out in circulation, there was a dollar in a bank vault backing it, but they wouldn't come forward and prove that for quite a long time. This year, the US government has actually gotten them to come forward with their records and prove what is backing Tether. And what they have is enough value to back all of the outstanding tethers, but it is not in the form of dollars. It's instead in the form of things that they've invested those dollars in, like corporate debt or like sovereign debt or different things that will earn interest over time. And so because of that, Tether is kind of backed, but at the same time isn't backed by exact dollars in a vault. Though it should be noted that when you go to a bank and you hand them dollar bills, they don't just hold those dollar bills in a vault in the back with your name on it. They actually do reinvest those dollars. This is what's called fractional reserve banking that we have in the US.
Interesting. But what if Tether was truly backed by US dollars? Would they still be having these SEC issues?
Well, Janet Yellen, the Treasury Secretary of the United States, like in Biden's cabinet, Janet Yellen has now created a commission to look into whether even just stablecoins that are backed by actual dollars are going to be permissible in the long run, because they're rethinking. Potentially, they're thinking we need to outlaw private stablecoins, period, and instead have kind of just like an official United States stablecoin This is what's called a CBDC, a central bank digital currency. And we'll talk about this in future episodes. But the basic idea would be having an official stablecoin, and any other ones are not blessed by the US government. And so they're, in fact, potentially illegal.
Oh no. So if they're not blessed by the US government, would this even include the stable coins that are, trying to peg themselves to, let's say, a cryptocurrency or crypto assets?
Well, yeah, some of those, yeah. So some stable coins, which again, remember, is kind of like a dollar on the blockchain. Some still try to maintain the value of $1, but then they have backing in something like Ether or Bitcoin or something. And even that, the US government isn't really happy with, because they don't want anyone else to have the ability to if we were to try to be as charitable as possible to their argument would be something like, if you have privatized stablecoins, then the US government has less levers that they can control to either increase or decrease the US monetary supply to help the economy when the economy is fluctuating. And so they want to have the reins, they want to have the steering wheel, and they don't want everyday consumers to think that this private version of a dollar is just as good as the US's version of a dollar, which they say has the full faith and trust of the government or something.
Right. And this reminds me of your earlier point of why the US government started regulating securities to help protect consumers initially. But what's happening right now, it seems like the US government is actually starting to be threatened by this rise of crypto assets. And that's why they're starting to regulate it, also to maintain control.
Yeah, I mean, again, what we should really keep in mind is that the regulators aren't like out to get you or whatever. They're trying to just enforce the laws as they're currently written. And it's just that the laws as they're currently written are decades old and didn't take into account crypto assets. And so these regulators are trying to make sense both of how these current laws affect this, and then also those that have some leeway over this are, I think, are well-intentioned in wanting to not have everyday mom and pop people have all of their savings disappear by some scammy crypto thing. But I think they might be throwing the baby out with the bathwater to then say, now everything must go through the US government. And some of the really more ominous versions of this are people thinking that the US government itself feels threatened by the possibility of a privatized parallel version of the economy potentially overtaking their power. And a lot of their power comes from the ability to print money and the ability to regulate trade between citizens.
Well, speaking of the difficulty with regulating, this brings up another case that was very unique, because in everything we've talked about so far today, it's been with any kind of crypto company that touches US securities or US dollars. But recently, there was New Jersey filing a cease and desist to order BlockFi, a company that helps people earn yield on their crypto, just for interest-bearing Bitcoin and Ether. What's your take on this?
Yeah, I mean, so BlockFi is a central company that just lets you, it's kind of like putting your money in a bank where you then earn interest on those dollars, except BlockFi was letting you do that with Bitcoin or Ether. So you would just put your Bitcoin or Ether with BlockFi and you would earn interest on it. And so this isn't really challenging US sovereignty on different things.
Right. And one big thing that happened was that New Jersey incorrectly claimed that BlockFi was decentralized finance instead of centralized finance. Maybe you can briefly explain the two and why that's such a big deal.
Yeah, in a future episode, we're going to describe what DeFi is, but a short version is DeFi is kind of like an app built on top of Ethereum that performs one of these functions. So remember how Ethereum is kind of like an iPhone and you can build complex agreements on here. One of the things you could do is you could build one of the agreements that you would traditionally have to have a centralized company do. And so that's more like DeFi, decentralized finance. But BlockFi is nothing like that. BlockFi is just a centralized company. It's just like a normal bank, except it accepts Bitcoin and Ether. And the problem is New Jersey incorrectly just assumed or stated in their cease and desist that BlockFi is the same as DeFi. It is the same as an app built on top of Ethereum. And these are totally different things. A centralized company in the real world versus a smart contract, an app that is running on top of a blockchain.
In this case, that New Jersey incorrectly made this claim, what larger implications would it have for similar companies?
I mean, this means that a lot of regulators might make some overbroad claims about their jurisdiction and might then be treating apps built on Ethereum as being equivalent to companies located in the United States that have people in offices that are doing everyday things. So we'll have to go into this in further episodes, but one of the promises of Ethereum is that you are replacing a lot of the things that you previously needed a bunch of people in a building to do, and you're writing it out in enforceable, immutable code where you don't have to trust that anyone is going to run off with money or anything like that, because it will function as it's written. And so DeFi is very different than centralized companies. And the fact that New Jersey doesn't know the difference between these two is really worrisome, because regulators might now try to lump in just apps on top of Ethereum as being as liable as a normal company, which is a totally different entity.
Well, this reminds me about your optimistic take of, what the government is trying to do and how they're just trying to do their job and regulate. And part of it is that it's just so difficult to understand. And I saw, on Twitter that BlockFi was calling for just more open dialogue to try to fix this problem. Do you think that's one of the more likely outcomes?
I hope so, because Ethereum provides just improvements on the way that we've previously done these things. And the reason that we've needed such strict regulations is that it's previously been the case that you've had some dude sitting in a white collar job where he's manually doing these different transactions, and there's a worry about them doing it in a mistaken way or running away with someone's money, or there's all of this trust involved in all of these complex spider web of white collar jobs. But if we replace a lot of those with this immutable code that will function exactly as intended the same way every time, we can really improve efficiency by leaps and bounds. Our current financial system is built on rails that were built 50 years ago, 40 years ago, and it really does not make a lot of sense that we're still using those rails today.
Right. So the big picture and hopefully something ideal would be a situation where all of these crypto companies and DeFi are working together with US regulators, and they can actually coexist.
Yeah, if regulators were to rethink how laws are currently written, this would mean both citizens and companies and regulators would have to come together, rethink how we currently regulate this. It's not to say that crypto shouldn't be regulated. It's just that it shouldn't be regulated by the laws that were written 50 years ago, and it shouldn't be assumed to function the same way that traditional finance companies that are built on computer systems that were developed 50 years ago. That would be a mistake to assume that we're on the same trajectory here. This would be like applying everyday print journalism standards to the internet and tweets or something like that. It doesn't make sense to apply standards that used to apply to just four main news companies all of a sudden to every single person's Twitter account or something like that.
I really like that today we covered so much of current events. I think this was the first episode where we spent so long doing that, but it also really tied into our earlier discussion of all of these different crypto assets.
Yeah, I think it happened to be the case that this week the current events mirrored a lot of the content that we were wanting to cover as well. And maybe in future weeks, we'll try to focus on current events that are somewhat related to what we covered. But at the same time, if there's a big current event, we'll have to cover that.
Yeah, absolutely. And for those of you listening, and if you're still here towards the end of the podcast, if you have any feedback, make sure to tweet at us at Byte-Sized ETH. And on the account, it also has both of our handles, because we will be looking there and on the YouTube comments to see if there's any kind of feedback.
Yeah, we both want feedback for particular things in an episode that you want more clarification on or follow up on. And we also want episode ideas, because each of these episodes has kind of a theme to them. And we have a good idea of some of the initial themes we'll be going through, but we'd love to kind of direct the podcast toward what you want.
Absolutely. And speaking of future themes, it seems like next week we're going to do an episode on stablecoins.
That's right. They're both in the news right now, and they're an exact follow-up to cryptocurrency.
All right. Well, I'm looking forward to it. If you guys are listening and you enjoyed it, please give us a 5-star. It really helps if you're listening on Apple. But otherwise, we'll see you next week.